rental at a time, and this is, of course, your daily financial news. It is Sunday, June 27th. Can you believe this year is almost half over? Pretty amazing stuff. A couple of quick things as we look at this Sunday. We kind of look at the second half of the year that caught my attention. First and foremost, Gavin Newsom, the governor of California, went ahead and extended the eviction moratorium for California out to September 30th. Yes, he said, CDC, the end of July is not enough. We are going to go out to the end of September. This is kind of what I expected to happen. It's what we've talked about. A little shocked, but I just don't get it. I don't get it. But it looks like this is now going to go on to the end of September. Of course, by the end of September, the weather turns cold in California. It goes from 75 to 72. So I fully expect it to be extended again. I hope not. I just said that because I'm just kind of cranky this morning. But yes, Mr. Gavin Newsom, you've extended the eviction moratorium to the end of September. You are truly, truly hurting small mom and pop landlords. I think you are going to suffer a pretty large loss of affordable rentals in the next year or two, as you have made being a landlord in California even harder than before. So there will be ramifications from this, but we shall see what's coming. Other things I've caught this morning is it looks like more and more fast food organizations, we've talked about Chipotle in the past, are having to cut their discounts and push higher and higher margin meals because the fast food organizations are really getting hit with input costs, meaning food and things of that nature are rising quite quickly. Looks like good old Hertz. Yes, the rental car company is going to be exiting bankruptcy on the 30th of June. That is the expectation. They're going to be coming out of bankruptcy basically a new company, right? Their balance sheet is going to be nearly pristine. They are going to have very little debt, lots of cash, and a stock price that I'm sure they can go to the public markets and issue more shares, a la GameStop and AMC and the like. I kind of feel for Avis, didn't go through bankruptcy, has a lot of debt. But yeah, Hertz is going to come out basically like a much stronger organization. So it will be interesting to see what they do going forward. Got a lot of things about real estate this morning that I captured. First off, I didn't see this before, but it looks like national rent, which is very interesting, right? National rent obviously includes everything, but it looks like national average rent is higher than I expected. It looks like it is going to be it looks like it's up 5.5% in May, which is the last month on record, to an average of $1,527. It is the largest gain in the last 15 years. Again, I see rent going up, and I don't see it really slowing down. I think we're going to see housing affordability lower, which means less and less people get yes answers, which we will talk about in a minute, which only means rent is going to be pushed higher. A couple other things I caught is it looks like the infrastructure plan, as we've talked about, is going to get approved, at least Part A. I do expect a Part B via budget reconciliation, which will be massive on its own. But I wonder, when do we start breaking ground? How many of these projects are quote unquote shovel ready? Because again, what I think is going to be happening is a lot of those are going to be, commodities, wood, steel, copper, cement, things of that nature, and pouring more demand into a supply chain that is not quite functioning really could take commodity costs even higher. Friday is again going to be the important number of the week. It will be jobs created in June, but there is going to be a variable on that report that maybe historically hasn't been that important, but we will be paying attention to, and that is wages. What is going on with wages? I expect to see wage inflation showing up already, but is it going to be a spike worth catching the Fed's attention, or will that be in the month ahead. My suspicion is wage inflation is sneaky. It will start showing up next month, but we should see some wage inflation this month. On to the real estate front, lots of things going on. I got a lot of this from my reading on Black Knight this morning. I read several articles on Black Knight this morning, pulled lots of data. It looks like buyer demand is dropping. This is what I've been telling you is coming with housing slowdown. Buying demand has dropped about 18% from the peak of 2021. There's a lot of guesses to why that is, and that's what they are, just guesses. Guesses go from buyer fatigue. They're tired of being outbid and being one of 10 offers. Could be summer escape. Lots of people going on vacations, and they're like, we'll take June and July off. We will go and look at buying a house later. Median price is up 23% year on year to a record $362K. Again, Black Knight gets a lot of the credit for these, and Seeking Alpha as well. Read a bunch this morning. There's a ratio I hadn't watched before called the sale to list ratio, meaning what did a property sell for versus what it was listed for. It posted a record 102.3%. A record, I think it was 54% of houses sold for more than asking, which is pretty amazing. One of the most important things that I caught this morning from Black Knight is their affordability metrics. You got to be careful when you talk affordability. I use California Association of Realtor, car.org's historical definition. They report it monthly. It's something that, again, Bruce Norris from the Norris Group introduced to me 12, 13 years ago. It's what saved us in the last crash. But not to be outdone, Black Knight has an affordability metrics. And what they look at is median income to median price. Again, nationally speaking, so it's not broken down by region or city or state. But they're saying that right now, the average buyer is spending 20.5% of their income on mortgage payments, which by itself is not useful information until you have context, which I'll give you now. The last 5-year average has been 20.1%. So we are above that today at 20.5. However, historically, when you look back 25 years and you don't include this you don't have this last 18 months being a artificial skewing of the numbers, the historical average, again, looking at 25 years of data is 23.6%. So again, what I've been seeing, at least in my market, is housing is affordable. It may be higher price, but when you include the mortgage payment and increase in incomes, housing is more affordable today than they were in the last crash and certainly in the last couple of years. But what I found very interesting in Black Knights is they have done the math. What happens if interest rates go to 4% and housing continues to go up at near current rates? Well, then by the end of the year, we have a problem. We have a problem. And this is what I see coming as rates go up. Housing affordability, if rates go to 4% average, 4, right now they're just over 3. So that's a 33% rise, but that's just math. If rates go to 4%, on the 30-year fixed rate mortgage, housing affordability really plummets. The average payment goes to 26.7%. That is way above the long-term average of 23.6. So according to this, we really have an affordability as long as rates stay low, right? But if what happens is the Fed starts tapering, they start restricting loans, which banks are already doing. I'm bringing to you that nearly on a daily basis. And as rates tick up, it really breaks at 4%, right? Affordability drops in much of the country at 4%. That is something to think about, right? And that's, again, what I am calling a housing slowdown, not crash. What we are seeing right now is as demand wanes, we talked about 18% earlier. Yep, drop in demand. That lower demand will mean that inventory creeps up. We've seen about a 20% rise since the March lows. I'm still calling for a big jump in June and July. But what is going to happen is prices will moderate. and we will see quality differences and things of that nature. And then lastly, I've been thinking about the supply, why the supply is so limited, why we've really seen a skewing in median prices higher. And there's a lot of things holding back supply. One thing that I think is going to prove to be an issue for 5 or 10 years ahead is a lot of home buyers have mortgage rates under 3.5% fixed 30 years. What is going to happen when you look out 2, 3, 5, 8, 10 years, when usually housing turns over for a family, is those potential sellers are going to go, we have a double whammy, right? We're going to sell this house. We're going to buy the next one. Our mortgage balance will go up, but so will our rate, and they're going to have payment shock. We haven't had this in a long time, if ever before, right? If you have a 2.5, 2.8, 3% mortgage, and then you trade up and your mortgage goes from 2.8 to 4.1, that is going to be a healthy delta. And I don't think a lot of people will be looking for that. There'll be a lot of upgrades to current house because of that. Next, we have iBuyers. iBuyers are really sucking off a lot of inventory that normally would come up, right? Zillows and Redfins. You go to Zillow, type in your house you want to sell, they'll give you an offer. A lot of inventory is not coming to the MLS, which we used to see. And then, of course, the moratoriums are holding back inventory that would normally come on the market. I think a lot of these could unwind, but I think we're going to see a pretty reduced supply going forward. So maybe the 3.6 average supply, it's going to be hard getting there, but I still think we get to 2.5 million probably by the end of the year. So lots going on. And then the last thing, we are basically at the midpoint of the year, right? We are basically 6 months through 2021. Hard to believe. Thank you for watching every day. But I'm wondering, are you happy where you're at? I always try to evaluate things at the mid-year. Are you happy where you're at? Great. If so, where are you going next? What are you going to change? If you're not happy, what are you going to do different? If you're looking at real estate and thinking about it, one of the things obviously I think you should do is you should get the course, How to Get Started One Rental at a Time. It's going to make you work. It's going to make you focus. It's going to ask for daily commitments. And what I'm doing for you is adding more and more bonus content. We're adding more and more stuff on the private Facebook group. So again, it's time to reflect. Maybe not this weekend, but certainly next weekend I will be reflecting. And have a wonderful Sunday. Enjoy yourself. Take care. Today's a great day to make some money. Let's be better than yesterday. Bye-bye.